Good morning, ladies and gentlemen. This is the first session and we have brought together the top leaders from the BFSI sector today. Today, the question after 15 months is not about how to deal with the pandemic because the scenario is pretty unusual even today. But liquidity is not a problem, but credit demand is. Consumption and growth is needed, but inflation is rising. The GST collection is supportive, but the government has its own challenges managing the fiscal, so on and so forth, because uncertainty continues. So the question is how leaders and the top management of the BFSI companies is crafting their strategy, unlocking the business values. In this session, I'm going to try my best to explore the same. But before we begin, let me suggest to you, ladies and gentlemen, to please post your questions, feedback in the comment box on your right side, and also share your thoughts on the social media using the hashtag ETBFSI CXO. So let's begin. And to begin this conversation, I have 5 gentlemen with me. And my first speaker today is Mr. Sanjay Singh, the Deputy CEO, BNP Paribas, India. Mr. Singh, glad to have you.
Thank you, Amol.
My next speaker is Mr. Rajiv Yadav, the MD and CEO of Fincare Small Finance Bank. Mr. Yadav, glad to have you.
Thank you, Amol. My pleasure.
My next speaker is Mr. Nitesh Ranjan, the ED of Union Bank of India. Mr. Ranjan, glad to have you.
Thank you for the invite, Amol.
My next speaker is from the NBFC side, Mr. Sunil Prabhune, the Chief Executive, Rural and Housing Finance and Group Head, Digital IT and Analytics, L&T Financial Services. Mr. Prabhune, glad to have you.
My pleasure, Amol.
And my next speaker is from the FinTech side, Mr. Anand Dalmia, the co-founder of Fisdom. Mr. Dalmia, glad to have you.
Thanks, Amol.
So thank you, gentlemen. And to begin with, Mr. Yadav, I will shoot this first question to you. In fact, I want all of you to answer this first question. It's for everyone, trying to understand how you are actually dealing with the pandemic and unlocking the business value. So the question, Mr. Yadav, is this: that steering between lockdowns and unlocks must have been difficult, obviously, for all of you. How are you actually managing your business? How are you unlocking the business value?
Amol, thank you. It's a very relevant question in the times. Clearly, the COVID-1 experience and the COVID-2 experiences are very different. At a summary level, we had a very stringent lockdown, and then we had gradual unlock along the next few months. And obviously, there was a lot of conservatism in that phase, where as a bank, as a country, we were being very cautious in the fear of the disease, and therefore we were treading the path very carefully. Having reached a certain point, obviously it drew into a lot of confidence, and I'll talk about business. And then obviously we all understand that that the COVID-2 came. So psychologically, the difference between the two phases is the bigger acceptance of the fact that unfortunately COVID is a combination of waves, and we don't know how many waves will follow. But there is a belief that the waves hopefully will not be as bad as wave 2. There is obviously vaccination which will solve to some of the problems if everything goes right. So now the way we are working is that we should see, even in the waves, we should see business continuity in a reasonable, normal way, where we should not completely lock ourselves up in terms of doing business. So we should have continuity in areas where there are lower number of cases and the disease is still small. And we should anticipate and take adequate precautions when we see curves going up. And in phases when the numbers are down, we should be doing regular business because we may need to slow down again when our next wave comes. So I think this is a new normal, that we'll all look at data and basis that decide our degree of business that we can do. But as the waves permit, we will do fairly normal business. So as a bank, pretty much we have followed this rhythm. We are a rural bank where we service millions of customers every month. And we have found that largely speaking, the rural base was unaffected because of COVID. And therefore, we were able to do fairly reasonable business prior to COVID-2 and even after COVID-2.
Yeah, well, if I could add to what Mr. Yadav just mentioned, I think what he said was so true. If we take a couple of steps back, the biggest effect of COVID's wave 1 and 2 have had on our enterprises, on our businesses, is what are we aiming for? What are we trying to achieve strategically? In normal times, pre-COVID times, those metrics used to be metrics like profitability, growth, or at more granular level, metrics like margins, metrics which were more efficiency oriented. That has all changed. Now, when we talk about how our strategy is playing out, the biggest metric that all of us chase is employee safety. And it is expressed in terms of number of employees who are vaccinated. Right. So there are business leaders who look at that number first thing that they wake up in the morning and track it through the day on day. Second parameter, which has assumed huge amount of importance, is liquidity. As you rightly mentioned, now the liquidity situation is fairly comfortable. But if you recall the dark days of COVID wave 1, liquidity has come to the fore as never before. Third parameter that all of us look at with great deal of focus is how sound are our portfolios. We are extra conscious, extra careful, and extra clear about risks. And fourth, and perhaps last from my side, how do we retain our customer franchise in these difficult times?
Okay.
In an environment where we are for the first time in our business lives, not being able to physically go to customer at will, how do we still maintain and retain that relationship? So clearly, business metrics have been turned on their head because of what COVID has done to us.
Thank you, Mr. Prabhune, for.
In fact, Amol,
please
what Mr. Yadav, Mr. Prabhune said, I just would like to add a couple lines over there. In fact, this reflected across our ecosystem.
Yes.
The way we interacted with our clients, our processes, employees, working from home, etc., all of them. And most importantly, business have been able to offset a good part of revenue impact by reducing cost and improving efficiencies. That is playing very important role in the profitability overall in general.
Okay, noted your points. How is it for you, Mr. Ranjan? How are you unlocking the business value? You heard other three gentlemen talking about it. What is your view, Mr. Ranjan?
I think COVID for us also was very challenging, as was for anyone else in the entire globe. But for us, another challenge with COVID was the amalgamation. So even after the announcement of lockdown, was the due date, zero date for the amalgamating the two other banks with Union Bank of India. And during the pandemic, during the lockdown, overnight, we became double the size in terms of network, in terms of business, in terms of number of customers. On the top of the COVID, we are in a situation where you have more people to manage, more customers to interact with, but the channels of communication got dropped drastically because you can't meet, and banking being a very high-touch business. That was really very, very challenging period. And being a high-touch business, our people continued to work from the offices and the branches throughout the pandemic, except for a few days when there was a strict lockdown and they were not allowed by the local administration. So that was another challenge on the people side, how to keep them motivated. Because at a time when no one was willing to cross their doorstep, and asking your people and getting the thousands of people come to the branches every day as a routine was very, very challenging. But thankfully, everybody supported and everybody came to the call for supporting the customer. And I think there were two challenges. One was definitely on the managing people due to the COVID and due to the amalgamation. And second was on the managing business, because suddenly we saw that many of the businesses started facing huge problems. Now, how to give them support, how to reach out to them without they visiting the branches and visiting the office. Those were the few challenges, but thankfully, I won't say that COVID is over, but we are seeing the much better period than what one would have anticipated a few months ago, a few quarters ago. And hopefully with the pace of vaccination that the government is pursuing, we should be in a much better place going forward. We are already seeing some improvement in the business sentiment overall and within the bank also. I would say the COVID has taught us something.
Yes.
One is that all of us over the last 5-6 years across the segment, particularly in the BFSI, we're thinking on the technology and the digital. I think there was a plan, something we'll do in 3 years, something we'll do in 5 years. I think 1 year of COVID has perhaps advanced many of those plans from 5 year to 2 year, 3 year to 1.5 year kind of thing. So that is one thing I would say is the positive outcome during this period of pandemic. And we also use this opportunity to reskill and train our employees because they were having some time to actually get engaged into those kind of training. So that's how we have used, because the future is going to be a lot of opportunities. If we have to see at India of next decade, there is a huge opportunity. So how do we prepare ourselves leveraging the people capabilities and technology is something we are looking at very, very passionately.
Very well said, Mr. Ranjan. In fact, I remember talking to a PSU banker in the middle of the lockdown, and he said, I would have never thought that we'll give a VPN access to all our employees, which we have already done. So that's the kind of transformation that we said. But I think on this front, Mr. Dalmia will have a different view because he comes from a fintech and a tech background. So, Mr. Dalmia, how are you unlocking the business value now?
Now, while we empathize with a lot of traditional businesses which face a lot of issues,
right.
I think, as a tech-first business, as a fintech business, we actually gained, while I would not like to gain for this reason, but, like Mr. Ranjan said, just the digital adoption of India as a country, of fintech platforms or of various services, I think we gained immensely out of it. Fisdom, works with multiple bank partners, to be their wealth management partner. So we were already partners to the like of Indian Bank, PNB, Karnataka Bank, City Union Bank, a bunch of other banks. I think for us, there were two large opportunities in front of us, which I would say, we were able to do justice to. The first one was expansion of a product suite. We realized that more and more customers would want more and more products completely digitally. So we started as a mutual fund platform, having a few other products. But in the middle of the pandemic, we did our first acquisition of a tax filing company. We got a broking license. We are going to go live with that. We came in with a few other products that our customers wanted. Secondly, we started integrating with the bank partners to leverage their digital distribution to reach out to their customers. Again, like Mr. Ranjan said, banks started focusing a lot more on digital, especially PSU banks. And if you look at any PSU bank presentation in the last couple of quarters, you'll see the number of mobile banking users growing by almost like 100%. Now that 100% on that bigger base is like, almost talking about 1 crore active mobile banking users for most of the PSU banks. And, we are integrated inside their mobile banking apps. So we wanted to leverage that to reach out to their customers digitally, which in the past, a lot of it was happening through the branches. And the last one was, can we get more partners onboarded? I think, we realized that more banks started realizing the need to offer seamlessly all products digitally to their customers. And you would appreciate that in the last couple of years, if there's one thing that has worked well and as if pandemic never existed, is the stock markets. So people's love towards wealth management and wealth management products is like all-time high. More people want it. And we, in the last 1 year, we've onboarded 4 new partners so that we can help the customers digitally. So I think while we didn't want it to be a boom as a pandemic, but I think digital companies, as a digital company, we've gained tremendously as a result of customer shifting completely digital.
Okay. Valid points, I think, gentlemen, from all of you, digital transformation, looking at vaccine certification, and, the future growth specifically derived under technology. But let me get some, fundamental questions to all of you, which the bankers and the BFSI companies are dealing with today. And Mr. Yadav, I will come to you first. Tell me, how is the credit demand looking like right now? Because, liquidity is no more an issue for any bank whom I have spoken to in last couple of days. But credit demand is. So what is the major challenge there that you see right now?
So Amol, as you rightly said, actually banks were big beneficiaries of liquidity getting enhanced in the COVID-1 phase. So I would say liquidity has not been a challenge at all, for the banks. And therefore, the only 2 operating principles which are challenges was, the first one was the portfolio quality that we all are having. And each one of us will have, concerns around that. Some could be higher, some could be lower, but there is no financial institution, a lending institution, which would not have concerns on that and would not be over managing it in the COVID phases. The second one, as you rightly asked in this question, it's about the enhanced credit demand. When you don't do incremental business, you can tend to degrow, or you obviously don't achieve your growth goals for the institution, which are also important even to a lower degree. So I would say now focusing on the demand side, we are blessed with the fact that we have about 2.5 million customers, and they are firstly from a geography which is absolutely rural. Secondly, they are at the what we can call the financial inclusion customers who create livelihood by actually working for themselves on essential commodities. So this COVID phase has obviously the least impact on industry / individuals or business which are working in the essential service space. So our customers who are largely related to agriculture activities, dairy and other ancillary activities, which were so essential in this phase, were largely unaffected, subject to the fact that in severe lockdown phases, they couldn't sort of transport their produce, and therefore they couldn't get their cash flows. So there was a bit of an impact where the lockdowns were severe. But to our good luck, these segment of customers were very resilient, and therefore they reached almost a full normalcy pretty much 1 or 2 months after the severe lockdowns were lifted in both the phases. So I would say to that extent, the customer's health was largely protected, and therefore the credit demand is also reasonably strong. We have seen even after COVID in the month of June and July, very strong COVID, credit offtake, which is similar to pre-COVID 2 levels and which is similar to pre-COVID 1 levels also. So I would say now there is pent-up demand, and especially in the right places with the right customer segments. And as long as we can service it efficiently, given the COVID restrictions which may still exist, and given the portfolio focus that we are doing, I think there will be definitely a slower growth, but there is a reasonable growth out there still for all the financial institutions.
Okay, noted your points, Mr. Yadav. Mr. Singh, you heard Mr. Yadav talking about the reasonable growth and the pent-up demand. What is your view? Do you feel the demand is back to normal according to you? Because you're catering to a different client compared to Mr. Yadav, right? How do you see it?
So in addition to Mr. Yadav, as he's at least mentioned a couple of the points, if you look at after almost 7-8 years, this is the first time where all the factors are favoring a capex revival. Low interest rates, lower leverage, efficient economic ecosystem, and demand uptake. All are indicating that capex will resume, if not now, then in the next 6 months. That itself should drive trade demand from here on. So that's what I just try to put it in the small few words summary rather explaining further, because Mr. Yadav already explained very well on the subject.
Right. So, Mr. Prabhune, I will tweak the question which I asked to Mr. Yadav and think, considering your exposure into the rural India, how is the demand there specifically in the rural India? Is it compared to urban India, and what kind of opportunities do you see specifically in this time?
I think it's a very good question, because we are now through this question not looking at just the overall average, but are trying to look at specific pockets of opportunities or challenges. Let me just go directly into your question. This year we are expecting now third close to normal monsoon in succession. Water reservoir levels are among the highest in recent history. Groundwater levels are decent. We have had fairly stable MSP regime. All of this translates into fairly strong footing for rural economy. As was earlier mentioned, ravages of COVID, while they reached rural India in wave 2, have been relatively less compared to urban India. So clearly, there are opportunities waiting there. Let me also expand that a little bit. If you look at our other customer set, which is the typical commuter in urban India, there has been a lot of pent-up demand for personal transportation, which is sure to come up to the fore as economic activity picks up. So clearly the picture is a lot more nuanced than what may come through in averages, that on the whole, on an average, the credit offtake is muted, but there are definitely pockets of demand which are there and which are thriving. Now, Amol, if I may just add one more aspect to it. We are all financiers on this call. So to us, credit is not as much about simply the act of lending as it is about successfully getting that money back with interest. So always our decisions will be driven by expectation of successful repayment by the customer. And that's where the scenario has changed quite a bit.
Okay.
You and I have been talking about use of analytics, use of behavioral analytics, use of propensity analytics, cleverly using machine learning in the process to predict customers' repayment behavior, tailoring your asset management strategies accordingly, how you will collect, what will be the right method, what will be the right mechanism, what will be the right time of the month, what will be the right time of the day. Use of that has helped some of us to recover our credit demand much faster. To give you an indication, in the first quarter last year, COVID wave 1, and now looking at COVID wave 2, our disbursements during last quarter, first quarter of this fiscal, was 3 to 3.5 times that of last year. That perhaps gives an indication of how things stand with us.
Okay, valid points, Mr. Prabhune. So, Mr. Ranjan, I will, spin the question to you as well. So, are you comfortable with the demand that is there in the market? I mean, first of all, how do you see the credit demand, and are you comfortable with in terms of unlocking the business value out of it?
I think credit demand is right now subdued, but definitely recovering from what we have seen in the last 3 months and 6 months. And that is across the spectrum, whether it is a rural India or urban India, and again, segment-wise, whether it is agri, retail, or corporate. The two segments which are definitely showing good demand right now is the agriculture and the personal segment, the retail segment. MSME and corporates, I think still it is very, very subdued. And as Mr. Singh said, there is a clarity on capex happening in India very soon. It may take time, 6 months, 9 months time. But if you look at 3 data sets, one is that how the credit has grown in the last 6 months incrementally. Second, if you look at the few lead indicators reflected by the PMI, which is recovering very fast. If you have recently seen the Nomura, the business confidence index, and also what RBI released very recently on the capacity utilization level of the corporates, you see today's capacity utilization level compared to a year ago is much better, and it is on the uptrend. And the third and the most important information is about the push by the government for the investment, for the infra credit, for the export credit, for the export promotion, and the PLI schemes which they have brought for the many of the manufacturing sectors. I think these all are going to create huge demand across the supply chain, right from the big corporates to mid corporates to MSMEs in the next 3 to 12 months period. If I have to look at few of the sectors where the demand will come, one is the renewable energy. I think that is definitely something which is picking up in our country. Secondly, related to infra, I would say the road sector. Road sector is still untapped in the country. There is a huge opportunity. Many projects are coming in. And I think past promoters have also learned from the experience. Therefore, the new projects are also into much better shape. If the capex happens, then the associated demand for the personal loan, for the housing loan is going to come, which will push the investment and demand from the steel sector, cement sector. I think, and one more important aspect we have to look at 3 to 12 months is about the government's focus on the agri infrastructure. If you minutely see the kind of focus and investment that the government is planning in this sector, I think warehousing, cold chain, these are one potential area which not only next 12 months, but I think next 36 months per se, will see a huge demand for credit from the banking and the financial system.
Okay, I think you listed even the sectors really well, Mr. Ranjan, and it looks really hopeful. In fact, it's a good positive. It gets some good vibes. Mr. Dalmia, you mentioned about the collaborations that most of the banks are having with the fintech companies. So the challenge for everybody is now to how to unlock the business value, how to get back to the normal. How these collaborations with the fintech companies or the tech companies can help the BFSI companies to unlock the business value? What are the also obstacles have you seen in terms of partnering or collaborating with these banks or the finance companies?
Look, I think, now working with 10 banks, we've learned a few things. On the credit side, also, I can say while we are not big on credit ourselves, but what we are seeing is, one of the segments that a lot of banks didn't focus on was actually the retail customer base. While as fintech companies, we are burning millions of dollars to get that customer base, banks actually already have that customer base. But, the focus was almost always largely on the corporate side. So if you look at a lot of lending fintechs today, they're talking about stuff like buy now, pay later, stuff like that, right? Now, banks historically have not done so much of unsecured lending, but as the with growth of more digital capability for the banks and maybe some partnerships, I think that's a very large segment that bank can tap into as a very lucrative segment, because that's an unlimited demand for credit at an individual level. Having said that, where we are trying to work with banks is again, the same thesis that today, when we look at banks, they have, massive trust of the customer base. They have the physical infrastructure, they have the data on their customers. But banks didn't focus on, some of the lower hanging fruits like fee income, like example, mutual funds or a tax filing or a broking. If you look at most of the banks, the fee income from that segment is not large, but that is directly to their bottom line. There is no risk associated with that business. And the customers, the bank always knows that the customers are buying it, because if I use the bank account to invest, the bank can see that debit. So what we are working with the banks is to basically help them leverage their customer base, their relationships, to create a very strong fee income for the customers, to get their wallet share of the customers, as well as increase the engagement of the customers. So everyone is talking about a super app. The banks have more customers than anyone else. Can they make it a super app by having more products that the customers want? So we started with financial products, but over a period of time, we want to move into a category where we are perceived as a digital partner for the banks by bringing in not just investment products, but other products that the bank customers want. So I think, like when I look at Yono and I see all the media around it, there is a talk around Yono being $40-15 billion of value. Now, if you look at the market cap of SBI, it is also in the same range. So which shows that the most important valuable asset of the bank in the future is actually the mobile app of the bank and the customers on that. So what we are trying to play our part is to bring more products so that the bank's engagement with the customers increases. We are hyper customer centered company. So how can we give that same experience that a fintech company provides to the bank? So it brings the best of both the world. You have the trust of a bank. You have the physical infrastructure. If something goes wrong, you can go to the bank, and you get the services and the experience of a fintech company. So that's how we are trying to unlock the value, not just for ourselves, but for our partners as well.
Okay.
Amol,
yes,
Amol,
yes, Mr. Singh.
I would like to add what Mr. Anand said. So, of course, he's rightly said, fintech has arrived, right? And use of UPI, mobile banking, etc., all have exponentially increased. And Jan Dhan has ensured more than 80% of Indian population is within the reach. So from buy now and pay later, online shopping, life insurance, SME loans in 1 to 2 minutes, all of this possible now, which was like dream before the pandemic. So I believe catalyst for this is pandemic, and old saying, necessity is the mother of the all invention. That's exactly what has happened in last 18 months.
Mr. Singh, you summarized it really well, but digital has actually put the transformation to a different level. I was talking to a couple of fintechs and they said that the demand for even going on a date is also very high. Youngsters are also taking a loan to go on a date and to attend the weddings.
Indeed.
That's a very interesting point. And yes, the value of Yono has increased a lot. And you can see the rally in the stock market from the fintech side, whether MobiKwik and Paytm. But let's talk about the crucial aspects of the economy and which the bankers are facing the more. And I mean, I will come back to you, Mr. Yadav. I mean, don't feel that I'm asking only tough questions to you or very critical questions to you. But considering, all the experts believe that, India has lost 2 years of GDP and now the inflation is also rising. At one side, RBI has promised that they will intervene as and when required. My question to you is, as a CEO of a bank, I'm sure you must be getting a lot of business proposals and all. So what are those positive factors that you are looking at it? What are those data points that you are looking at it, which may be helping you to take the right decisions or which are helping you to bet on, okay, this may work in future? Because for you, taking that risk is very, very crucial now.
So Amol, I would say, clearly a lot of us will have to look at this pandemic phase in two aspects. One, a phase where clearly there will be a loss of 18-month period where we could have done business, but we couldn't do. We were just in a standstill mode to a larger degree, and where we were surviving more than thriving in this phase. That's one way of looking at it. The second would be obviously all the benefits of this pandemic in terms of digital evolution from the customer's perspective, our own investments, our better understanding of risk, clearly showcasing business models which can take these kind of challenges and still survive. So in some sense, it will weed out the weaker players. So all those positives will have obviously flown through. But this pandemic from largely a business perspective has been, stay well, stay put, manage what you have. It is okay if you do not have too much of top line success, but try and have the best HR outcomes, as was said on the employee safety front. Try and survive yourself in a lot of different ways. And then, survival has been one of the larger objectives in any context, if we may say. Now, so I guess we should not worry about 1 or 2 years lost in terms of GDP growth or anything else, or the degrowth that we had in this phase. The key question from a country's perspective would be that can we look at this calendar year, assuming no COVID-3, and when we compare to 2019 data, are we in a negative zone, are we in a neutral zone, or are we in a positive growth zone? Because versus 2020 data will obviously be hopefully in a positive zone all through the year, because those quarters were quite bad. And as long we can look at 2019 data and we can broadly say we are doing better than 2019, and maybe we have lost a year in the middle, maybe it's only a 5% growth versus 2019, then it's okay. We'll forget 2020 and we'll say we're back to normal. And then 2022 will follow based on 2021 data. So that is, I think, from a macro GDP perspective, that we should not worry about a year or two lost, as long as we could show a growth rate versus a stable year earlier, and that becomes a reference. So a business perspective also, almost all metrics we take back to pre-COVID numbers and say these are stable numbers, and if you can broadly get there and better those numbers, then I think we are in a good zone, and then we can say business is back on a normal track on all parameters, the growth parameters, the portfolio parameters, and otherwise. From our perspective, as was again alluded earlier, that risk taking in a post-pandemic world is a very important factor for all of us. But retail lending, given large numbers, is a relatively safer bet rather than corporate lending, where you still need to figure out whether the industries are doing well and the demand is picked up. So I would say, one, we are blessed about the fact that we are a retail bank and we are taking more retail risk. And clearly the resilience of the retail segment is much better. And I would say the fear of job losses and everything is also much receded. In some sense, there's demand for talent, and largely, employment would be coming back. But I would say it is also a better world on risk taking, because now when we look at customers, we are actually able to see the difference in risk of customers much better. Because clearly we just plain and simple look at it and saying, how did they perform in COVID-1? How did they perform in COVID-2? Because all of them typically have credit histories. Yes. And if a customer has done well in these two phases, trust me, he's a gold customer for anybody. Right. So prior to COVID, we cannot even trust a perfect track record. It could be a track record based on taking more loans and those kind of behaviors. But COVID has actually separated the great, the good, the average, and the bad much better. And therefore, our confidence is much good, when you look at some of these data points. If somebody doesn't have a credit, it goes back to basics and you underwrite on basics. So I would say it is just picking up the right risk or the right segments, which we have to sort of focus on. But for no COVID-3, I think largely speaking, retail lending portfolio has stabilized and fear of incremental lending is no longer there.
Okay, I think a detailed perspective, Mr. Yadav. Mr. Ranjan, would you like to add something here, considering PSU banks are always a flag bearer and they are the one when it comes to infrastructure risks or something, they are always ahead. So do you want to add something here?
Yes, I would just echo what Mr. Yadav said. See, losing few quarters for regaining the same kind of GDP is one fact, but that is true for almost all economies in the world. What is different here is the rate of bounce that we are experiencing. See, this year we are expected to be around double-digit GDP growth. And all indicators, as I also alluded in my earlier answer, that most of the lead indicators are showing that we are going to leapfrog in terms of growth in the next 3 to 12 months at least. And now on top of that, one more thing, if you see, as Mr. Yadav also touched upon, today financial institutions have the advantage of digital and data both. Digital for reach and the scaling, and data for better underwriting, better understanding of the customer. That is what each financial institution, and we are also as a bank, we are leveraging that to a great extent. And that is the point actually where people like Mr. Dalmia come in with a fintech experience. And I think going forward with that kind of fintech collaboration, understanding those kind of data sets in a better way, and then offering right kind of credit product, better monitoring of the credit, that is what is going to happen. So I am very sanguine about the credit growth that's going to happen in the near to mid-term.
Okay. So Mr. Prabhune, everybody is very much bullish on the rural India. My question to you is, obviously you are also, the advantage is you are also heading the IT and tech part, so you must be having, great synergy of, data analytics using it there. But the question is, are you monitoring the loans that you are disbursing to the rural India far more aggressively now? Because yes, there is a demand, but there might be a stress in near future because you never know how the situation will pan out. So are you monitoring the loans that you're disbursing far more aggressively than ever?
Amol, clearly, the answer to this question, let me also lean on what some of my colleagues on the panel have already said and try to summarize that. During this pandemic, some of the strengths that we had built up over last few years came to fore. Very clearly, it was not possible to re-architect an entire organization in the middle of pandemic, right? You could only play on the strength that you had already created. And that's where we feel that organizations like us carried the advantage of having given primacy to data intelligence over conventional wisdom. Rule of thumb was set aside for better insights that data created and use of digital to reach across and build a portfolio of 8 million current customers. Now to your question, because we always looked at ourselves as one of the link in this large chain, we didn't look at ourselves as owners of customer relationship. We looked at ourselves as custodian of customer relationship. Let me elaborate. If there are key functions that we have to perform, which is underwriting and managing a loan, sure, we do reach across to the customer to acquire the account, but the decision to underwrite takes into account a partnership with a credit bureau, partnership with multiple fintechs who help us read the customer's financial statement, tax statement, utilities bill, so on and so forth, to create an amalgamated view of the customer's credit. Then our partnership with some other players help us write better algorithms to take credit decision. For disbursement, we depend on banks. For repayment, we depend on payment outlets, payment banks, all the different payment technologies that have been created. So clearly, we are just the conductors of the orchestra, and there are these brilliant instruments being played by virtuoso musicians, which is around us. Now, if you look at the overall relationship with the customer, it is managed by us by taking care of what customer needs rather than what we manufacture.
Mm-hmm.
So today, my products per customer ratio is more than 4. At least half of these products we don't manufacture. We only connect our customer with the manufacturer of those products. Those products could be in the nature of protection.
Okay.
They could be in the nature of health. They could be in the nature of roadside assistance for a vehicle. There is a bouquet of about a dozen products which are made available to the customer. So we are just a important link, but a link in a chain. Now about monitoring of the portfolio, and we have spoken about this before when we connected
Yes.
for other discussions. Monitoring for us starts not at the level of when something is going wrong. The monitoring starts with what is likely to be macroeconomic scenario as it pertains to a particular unit. The unit can be an agroclimatic zone. The unit can be a district. Unit for the purpose of credit can also be a PIN code.
Uh-huh.
At customer level, our entire emphasis is that how do we detect something is likely to happen rather than something that has already happened. So before the customer turns one day overdue, can we predict that behavior using behavioral analytics? And somewhere that is what has worked well for us, and that is what has given us the license to actually grow our book. We remain quite sanguine about the impact that COVID has had because of our control over the portfolio, and clearly also extremely prudent and conservative provisioning policies. Just because you are on top of the situation doesn't mean something unexpected may not happen.
Right.
And there is no replacement for prudent and conservative provisioning as well.
True. Noted that. So Mr. Singh, do you want to add something here in terms of what is the response that you get from the market when you speak to the mid-size or the large corporates? What is the response, or what is their worry specifically when in terms of borrowing? Because at one side, we understood that there is some kind of credit demand, and we're expecting some credit demand, but they have their own challenges and problems. Few of them have lost their businesses. So what is the sense that you get?
So no, thanks, Amol. Frankly speaking, our other three experts very well explained and not covered like one particular sector. They covered like across all economy, in start from retail to the corporate. But I would like to answer this question a little differently. I would like to take all of us a little bit back, a few years back. For example, if you look at pandemic, how that acted for the helping to the economy, which was already hit by various events. Right from the telecom and coal scam in 2013, through demonetization in 2016, a new GST regime in 2017, and the NBFC crisis in 2018. These repeated blows had struck business confidence hard. And just when the pandemic looked like a death blow, government support and the people's resolve has reignited the animal spirits here. A few statistics here. Capacity utilization is north of 70% now. Rating upgrade to downgrade ratio is at 3 years high. Volume offtake across industries, real estate, automobiles, FMCG, etc., is incrementally getting better every month. Other high frequency indicators, fuel consumptions, traffic on road, electricity consumption, all are showing signs of improvement. One of my colleague expert earlier mentioning stock market is now stopping, is continuously going up only. Our interaction with corporates and are indicating CapEx plan are back on the table, and they should start spending over the next 6 months, at least immediate if third wave is not coming. All of these signs are showing very clearly like improving business confidence. And when it's like, when it's improving this business confidence, everything got to reflect and we'll see result on the ground. So yeah, that's my view. Yeah, we are on the right path, which was lagging for many years.
Okay. So, Mr. Dalmia, quickly, I want to understand one part here. Most of the banks and the financial institutions always talk about the high cost of customer acquisition, right? Which is low for the fintech companies. So, has it really benefited you maybe to scale up further? If yes, what is your customer acquisition cost, and what is the retention cost as well? Could you just give us those dynamics?
I would say, actually the reality is that fintech companies' cost of customer acquisition is higher than traditional businesses because we don't have a physical infrastructure.
Right.
You need to spend a lot of money on your branding and in the product. Now, having said that, look, cost of customer acquisition for Fisdom is probably one of the lowest in the industry. The reason is, as I said, we partner with banks. They already have a customer base, and we leverage that customer base. So I would say our cost is largely, the support infrastructure and the people that we deploy for our bank partners, rather than the branding or digital marketing that we have to do to acquire those customers. Because, like Mr. Ranjan said, they already have the data in digital. We just need to write that to get those customers. And as a result, the cost of customer acquisition is not high. Now, the other part is, what is the cost of retention? I think, today's customer is the king. I think the pandemic, one thing is brought to the fore is the customer is the king, and in its truest sense. Accessibility, awareness, these issues are gone because, today is access to the net and anything that he needs to be aware about, he can be aware. So what needs to be, and the customer is very finicky also, because, he has many, many options available to him. So what is required, where we invest a lot of money and it's difficult to quantify, is actually, the hyper customer, I would say centricity, which is at 3 levels. The first level is at the product level. So customer experience is something that, we keep on working. Like every screen that we have on our app, we do a very detailed analytics to know, what is the customer response, where he's falling and everything else, to make sure that the customer centricity and his experience is at the highest. The second part is engagement with the customer. These days customers' attention span is very low. How do you get the attention of the customer? If you write a big blog, no one is going to read it. So you need to now come up with shorter videos and with some sort of a content that is appealing to the customers, right? And going through mediums on which the customer is there. So today you would have seen the revenues of people like YouTube and all have gone and hit the roof, because we are probably consuming more videos than we've ever done in our life. So the mediums on which you create this, this consumption of content for the engagement of your customers also becomes very high. And the last is the servicing of the customers. The customers also have become very demanding when it comes to turnaround times in servicing. So how do you automate more and more of your servicing so that the customers, get a wow factor? People talk about, big data, application to make sure that you can predict a customer issue and solve it there, right? So right from, bots to everything that we have to include in a proposition, so that the customer today can get a very fast response time. And all of this is measured through the NPS. So we try to make sure, okay, how do we know whether our customers are happy? How do we know the product that we have, they're engaging with? So looking at data and making sure that, all that we are formulating and spending on can be measured and monitored. Like I think Mr. Prabhu said, like, look, you measure everything with data and take out your own views and opinions out. So, as a company, we think that, data is God, and for everything else, it's an opinion. So we keep looking at data very, very closely to make sure that on all these 3 parameters, and that's where a lot of expenses are there. So to quantify and say that this is my per customer retention cost, it's very difficult, because that the entire firm is working towards that. But I would say the customer today is much more demanding than the customer of the past, because he's got many options.
Okay, valid points, Mr. Dalmia. And watch is ticking. I didn't realize it's almost 45 minutes. But I will take one common questions to all of you, and that is more about future perspective. And we are in a situation where I think India has lost 1 million jobs almost. Most of the sectors are not hiring. On the BFSI front, we are hiring more engineers, but not the financial analysts. And the whole world is changing and heading towards the digital. So, Mr. Yadav, I will start with you. What is that unusual thing that you are going to do over the next 2 years to make your business strong, to make your bank strong, and to help the economy in a way that if you are strong, then obviously you will contribute to the economy. So what is that you're going to do over next 1 to 2 years?
We are a very young bank. So therefore, we are only 4 years old, and therefore there are lots of basic banking objectives that we have to still sort of go and complete, which were missed out in a year of opportunity that we couldn't sort of complete those on the ground. So I would say, as a Fincare Small Finance Bank, we'll have a lot of very simple objectives which we have laid out in the banking domain, introducing more products for our customers, increasing our ratio of the products. We started with the microfinance as a primary product. Obviously, we're adding other alternate products for our customers. So changing the ratio, building a great deposit franchise, all those objectives, which are what I call very basic, good bank objectives, continue to remain. And, we will look forward to a world where we don't have to work under the fear of COVID or a lockdown to start achieving those goals, because those goals require, field work. As Sunil said it, you cannot re-architect the institution in the COVID phase. So there is a unbuilt part of the house, and this house takes 5-10 years to build. So we have got those things to sort of go and execute. Luckily, the digital platforms have been significantly built prior to COVID and in the COVID phase. So I would say broadly the thinking has to change. The delivery of the products, even the traditional banks these days are are thinking like fintechs, and a lot of them are executing like fintechs. But so, this has accelerated that design, and Fincare, as one of those banks, in-houses a lot of the digital talent. We do use partners who are doing it for us, but we in-house talent. So if you have to ask me one, that we need to in-house even more talent, because digital will be the future, and to get speed to the market, the products out there, we need to sort of in-house more digital talent rather than depending upon others. We should just have more talent inside, so that turnaround times and execution can be better. Beyond that, I think just back to normal, a lot of different ways, personally and professionally, would be one of the good outcomes for all of us.
Okay. Thank you, Mr. Yadav, for that. Mr. Prabhune?
See, very clearly, we are obviously affected by not just the damage to the economy, but the personal blows from which we have all suffered. I have myself lost 18 of my colleagues out of 21,000 over the year and a quarter of this pandemic. So that is definitely a sobering note. But looking forward, there are a lot of positives to build on. One of the things that my organization has prided on over the last 5 years is the digital capabilities that we have built to create our 8 million customer base. During the continuation of the pandemic, we created a native digital business. There is no field force, it's end-to-end digital fulfillment, and have taken it close to 1,000 crores. So that's one strength that we are going to build on. Second strength is something that has become now part of our DNA, which is use of data intelligence rather than conventional wisdom or rule of thumb for decision making. And again, where we stand out in this is that most of the thinking on analytics is centered typically on customer acquisition and on credit decisioning. While that is essential, it's not a differentiator. We believe the biggest differentiator in analytics comes when you apply it to management of cost and management of portfolio quality. That's second strength that we have built. These two strengths are what we are going to use to build our future. Clearly, two areas we have identified. One, we are market leaders when it comes to financing farm equipment in our country. We would expand that to create, again, a digitally enabled business that takes care of far more needs and requirements of farmers, both on loan as well as on financial services side. Second, our digitally native business is in the area of unsecured credit. We believe tremendous opportunity exists when it comes to certain specific end uses, which we believe are socially as well as personally desirable. And we believe, given fairly low level of finance penetration in those segments, whether it is education, whether it is hospitals, whether it is hospitality, some of those areas, we believe we can use our digital muscle to definitely see good growth for the organization.
Okay, noted your points, Mr. Prabhune. I'm so sorry to hear your loss, but unfortunately, that is the case with almost all the institutions. Mr. Ranjan, your thoughts?
Yeah, I'll give a 3 to 5 year perspective. I'm a very optimistic person and very sanguine about how the financial sector is actually going to transform the entire India. I would say traditionally, banks feel that a customer has come to avail a home loan. I think that is going to change dramatically. Reality is that a customer, a consumer, wants to own a dream home, wants to buy a dream car. We mistake it that she is trying to avail the home. I think that has to change significantly, because the customer expectation and the expectation for the experience is changing very fast, not because of what other players in the BFSI are offering, but because the entire ecosystem is offering a different experience to the customer, way beside the BFSI. So I would say that in the next 3 to 5 year perspective, if I have to look at how Union Bank of India has to place itself, the 3 interventions that would require is how to better leverage digital and data. Secondly, how to build capacity in the people to manage digital, because today my people are ready to manage the traditional bank. If I have to shift to a digital banking, there is a completely different ball game, right from the customer acquisition, customer engagement, and engagement through the life cycle. So I have to reskill my people to manage that. And thirdly, most important, being a financial institution, which is going to remain for years, decades, and centuries to come, is to continuously invest in the right kind of risk architecture so that whatever we do with the money of the public is safe and public continue to have the same trust in the financial institution. Thank you.
Thank you, Mr. Ranjan. Mr. Singh?
No, thanks, Amol. Again, and sorry to hear the loss of our colleagues from their offices. And as you rightly said, it's across the case. But yes, not to topic to discuss here. As Mr. Yadav said in the beginning, they are pretty young bank, I think 4 years old. But on the contrary, BNP Paribas is pretty old young bank. And in India, itself in India, we are like 161 years we are completing in India. We become yes, indeed. And in the Europe, we become the #1 European bank because of the strongest balance sheet. Of course, across the table, we are talking all over transformation from old school to new technology way and all those. But I personally believe, and I think my employer, BNP Paribas, also believe in the value of wisdom of old school banking. Our mantra is to balances between best of traditional banking and the focus on relationships, human touch with new age technology to make processes more efficient. Because at the end of the day, when you talk to the few of the clients, everyone's like too much overdose of technology, too much overdose of the meeting through Zoom or anything. And sometimes they say, no, enough, I have done 4 meetings today already. When you look at like a little old school, when you go and meet with a client in person, you don't only talk just like business and to the point. You talk so many other things. Those touch are a little bit losing. And sooner or later, we all gonna to realizing we need to balance the both. We can't take either typical old school or the new way technology. So we believe in this philosophy to move that way. And at the end of the day, of course, we also keep in mind our long-term strategy and scale the business accordingly.
Okay, thank you, Mr. Singh. And Mr. Dalmia, what can we expect from you? Don't tell me you're hitting the stock market next month and join the rally of the other fintech companies.
So I keep telling my team, we just need to do boring stuff, keep doing of what we are doing more and more every day, rather than trying new stuff. So the 3 pillars for us, where we want to focus all the time is our employees, our customers, and our partners. So, how can we, focus more on our customers? How can we, make sure that we are able to attract and retain the best talent and work with more and more partners? That's the 3 pillars that we work on. I think, the mantra that Fisdom has is democratization of finance. Now, there are 3 sub-segments of democratization of finance, if I can put it that way. One is obviously giving the choice to the customer rather than, pushing them into a particular product, no mis-selling. So, that's the first bit that we have, I think, already achieved. The other 2 pieces are, how can we make the products available to the real Bharat that everyone keeps talking about, right? So, when we look at the mutual fund industry, AUM, Maharashtra itself is like 50-60% of it, right? How do you make sure that the real India, even to the interiors of India, you can make, simple financial products available? I think, we've taken a very unique way of doing it, which is through partnership with banks that have access there. Like we partner with India Post Payment Bank, which has access to, the rurals and hinterlands of India. We partner with large PSU banks, which have access in branches there. So that's the other thing, how do we get not just to the metro cities, but the real Bharat? And the third is, today there are a lot of products that are available only to the rich. How do we, make those products bite-sized and available to the hinterlands and the real people so that they can also make use of the product? Like you have wealth managers going to the HNI customers and offering them certain products which are not available to the poor, or, so I think the entire financial services industry, thanks to digital and the low cost of servicing, is now getting to bite-sized products. So we are working with the regulators, with the manufacturers who come out with such products so that there is democratization of finance in the true sense. So that's that's our mission of democratizing finance. And the three pillars are our employees, partners, and our customers. And I think we are very focused on just making sure that we deliver on that.
Okay, valid points, Mr. Dalmia. And I think that comes to an end. Thank you so much, gentlemen, for taking part into ETBFSI 6 Conclave and sharing your thoughts. Thank you so much, Mr. Yadav, Mr. Dalmia, Mr. Singh, Mr. Ranjan, and Mr. Prabhune. I'm so sure the remarkable insights that you showed, the participants must have enjoyed it and they will incorporate your thoughts into their learnings. Thank you so much once again for taking part into ETBFSI 6 Conclave. Thank you so much.
Thanks,
Thanks a lot. Our pleasure.
Thanks a lot.